Today, giving credit where credit is due. The DFA Daily to the 30th of October 2020. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. Well, once again, it's the last working day of the month, and so we get the credit data from the RBA, the credit aggregates, and from Apra relating to the ADIs or banks. And there's some quite interesting information in this series today. And we also got an update from Apra on those loans that are still on principal and interest repayment holidays. But let's start with the RBA data. So this is the RBA series relating to financial aggregates. And it's worth noting that they make seasonal adjustments to the information. Now, there's no explanation at all as to what basis they use for that seasonal adjusting. And of course, this has been an atypical year, so frankly, I'm a little bit sceptical about the adjustments they make. But nevertheless, what they show is that overall housing credit rose just slightly in the year to the end of September 2020. Business credit slowed. And we can look at this in more detail. Let's start with the monthly credit aggregate movements. So credit for housing rose 0.4% over the month. And that was supported with owner-occupied credit up 0.5%. That's a small rise compared with last month. And investor lending rose 0.1%. Hardly stellar, but at least in positive territory for once. Personal credit was still lower, down another 0.8%, although the trajectory is for smaller falls than previously. Whereas business credit lending shrank again a 0.3% over the month and remains in negative territory. Now, we can also look at the monthly credit aggregates, and together, total credit rose by a massive 0.1% over the month. Hardly moving the dial. Whereas broad money was at 0.9% up over the month. Not as high, of course, as that massive spike earlier in the year, but still significantly higher than the previous trends. Now, the more useful annual credit aggregates reported that housing credit overall over the last year has grown by 3.3%. Within that, owner-occupied lending rose at 5.4%, and you can see there the gentle rise over recent months. Again, not stellar. But investor lending slipped 0.4% over the year, and of course, that is a slightly stronger result than previously, but still not very strong at all, and it continues to support our thesis that property investors are definitely not that interested in the market at the moment. Personal credit dropped 12.5% over the year. That's a massive drop, but we must remember that a lot of people are now using Afterpay, and Afterpay is not a credit product, particularly if you're using a debit card. And we know that there are a lot of people who've switched from personal lending or credit cards to these buy now, pay later type loans. So it seems to me that, in fact, the true status of personal credit is probably understated. And of course, those buy now, pay later organizations argue that they do not offer credit despite the fact that they receive regular structured repayments to repay a debt. Business credit grew at just 2% over the last year and continues to languish. That's a very concerning indicator. And then if we look at the total credit, it's sitting at 2%. That level of growth over the last 12 months is as low as it's ever been. On the other hand, broad money is a massive 12% higher, and frankly is in territory that I've never seen before. Now, if we then switch across to the Apra Statistics, these are the monthly authorised deposit-taking institutions, and there you can see that owner-occupied lending over the last month rose 0.73%. That's quite a significant rise from last month. Investment lending fell 0.25% over the month, and that put total credit growing at 0.38% over the month. And in dollar terms, that means that owner-occupied lending is at $1.14 trillion. Investment loans are at $636 billion. And total credit for housing is at $1.778 trillion, which is another record. So despite all the noise in the system, credit is still growing. It's just the rate of growth is very low. The ratio of investment lending to owner-occupied lending has now dropped to 35.8%, which is as low as it's been for a long time. And we can also look at the portfolio movements within individual banks. And here we show both the blue owner-occupied movements over the month and the orange investment loans over the month. And interestingly, ANZ lent the most for owner occupation, but also took back some investment lending. CBA grew both their owner-occupied and investment lending, as did Macquarie and Bendico, and even Newcastle Permanent Building Society, Teachers Mutual, and a few others. But interestingly, if you go down to the other side, Westpac saw a further reduction in both their owner-occupied balances and their investment loan balances, whereas National Australia Bank, ING, saw a fall in investment lending, and Suncorp saw a fall in both owner-occupied and investment lending. Now, it should be said, of course, that this information is self-reported by the banks and is subject to the normal vagaries of this process. But nevertheless, it does highlight the different portfolio strategies amongst a number of different organisations, and ANZ in particular, who reported this week with lower profits, higher bad debt provisions, and considerable pressure on margins, is definitely upping the game in terms of trying to write loans at the moment. Now, elsewhere, the ABS also published some statistics up till the financial year 2019-20, which showed that both GDP and household final consumption expenditure fell. And they fell significantly. And they said the Australian economy contracted 0.3% in 2019-20, according to the ABS figures. And this is the first time since 1990 to 91 that the annual economic activity fell. So the onset of the COVID-19 pandemic ended 28 years of consecutive growth. A fall in household consumption dropped 1.6 percentage points from GDP, and that's the first recorded annual fall since 1959 to 1960. And private investment detracted 0.8 percentage points, with reduced investments on dwellings and machinery and equipment. And public demand contributed 1.4%, with ongoing spending on health and social services. And they also made the point that they provided further insights on the structure of the economy using the latest economy-wide supply and use data. The 2019-20 data showed that the largest industries in the Australian economy were mining, financial and insurance services, healthcare, and social assistance and construction, which represented over a third of the economy. The mining industry continued to expand, recording its 16th consecutive annual growth, which reflected increased oil and gas production. And it's also worth noting that the annual counts provide key indicators from balance sheet and productivity estimates, Australia's labour productivity rose 0.5% in 2019-20, which is below its 10-year average of 1%. And there were falls in 11 out of 19 industries. And finally, household net worth increased $485 billion to $11.1 trillion in 2019-20, with a $91 billion increase in cash and deposits and a $375 billion increase in the value of land. So, to my mind, this indicates some significant pressures on the economy, and it comes back to that fundamental question I've raised a few times about where future growth is going to come from. I continue to suggest that the settings are not optimal at the moment, and it's going to be increasingly hard to pull ourselves up by our own bootstraps unless things change dramatically. Now, the last thing I want to talk about this evening is the temporary loan repayment deferrals, which were reported by Apra today. Of course, many authorised deposit-taking institutions have granted temporary relief to borrowers impacted by COVID-19, allowing them to defer loan repayments for a period of time. And Apra does publish information based on what they are told by the individual lenders. Of course, there's no cross-checking, so they are simply taking the word of the lenders as they report the information back to Apra. And what they showed is that as at the 30th of September, data submitted by the ADIs showed that $179 billion worth of loans have been granted temporary repayment deferrals, which is around 6.7% of total loans outstanding. Housing loans make up the majority of total loans granted, although SME loans have a higher incidence of repayment deferrals at 10.8% of SME loans, compared to 7.4% of housing loans. And they said that exits from deferrals continue to outweigh new entries for the third straight month in September, with $66 billion worth of loans expiring or exiting deferrals, and $17 billion of entries approved or extended. And the pace of exits, they said, increased significantly over the month, with total exits increasing 169% from $24 billion in August. And the majority of loans have returned to a performing status. And it's also worth noting that the highest rates of deferrals reside in Victoria and the Northern Territories, with Victoria leading the way for housing deferrals and the Northern Territories for SME deferrals. And finally, they do provide some breakdown of data by individual lenders. And it's interesting to note that the Bank of Queensland and AMP Bank are actually at the top of the list in terms of those deferred, compared to the share of total loans outstanding. The largest movements in terms of loans expired or exited were at the Bendigo and Macquarie Bank. And CBA was also up there. Of course, CBA had a strategy of automatically deferring loans for SMEs. It's also worth reflecting on the interest-only footprint of loans. And I note that Suncorp is not actually reported of loans above 90% interest only. And Bendigo Bank has the highest proportion of deferred loans, over 90%, followed by Macquarie Bank and then Westpac. With regard to interest-only loans, CBA and Bank of Queensland have the highest shares of loan-to-value ratios of those loans in deferral. Now that could give us a little indication of potential risk in their portfolios. And finally, they showed a comparative chart which shows the percentage of business loans and also housing loans. And the Bank of Queensland, AMP, ANZ and NAB are in the highest risk segment of the chart, whereas HSBC, Suncorp and Bendigo are less exposed. Now, I find this quite an interesting analysis because what it highlights is that the banks are actually not all in the same boat. Some banks have much higher exposures in terms of high loan-to-value ratio loans or interest-only loans, and others have higher exposures across multiple dimensions, particularly business loans as well as consumer loans. And I will make the point once again that in my view, it is business loans that are going to see the most considerable pressure coming on over the next 4 to 6 months as JobKeeper is rolled back. Whether in fact those loans go bad or whether those businesses fail will be determined partly by the opening potentially of the borders, particularly for those in the tourism and education sectors. But there are also a number of other businesses who are close to the wind, particularly the retail sector. And in my data, retail is where a lot of the issues are going to be over this period. So standing back, we can certainly say that there is a little bit of better news in terms of loan growth, although I think it's marginal at best. But I expect the mainstream media will be celebrating massive growth in housing lending. That's how they report it. It's not true. But these deferral figures are still quite concerning. And I still think it's worth considering that there are still businesses and households who even now are seeking new deferrals on their principal and interest loan repayments. That is not being widely reported in the media. And once again, I think that's a very significant element. And it sort of resonates with my analysis that suggests that we've still got considerable stresses and strains within the economy. And next week, on Tuesday, in fact, I'll be updating my stress data for October. And I can tell you, looking at the data as it's coming through, there are some very interesting signs there. So join me next Tuesday at 8 p.m. Sydney time so that we can walk through the latest data. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.